We're going to start with the macro front, but we want everyone to participate in this now. So let's start with the macro picture, and I want to see a show of hands. How many of you believe that interest rates will be 100 basis points lower by the same time next year? Wow. How many of you think it's somewhere between, they will be lower, not 100 basis points, but lower? Okay, so there is some conviction around that. Eric, let's start with you. We had a long chat about this. 2 years of inflation uncertainty, rates volatility. What is the landscape looking like, and what is the most underappreciated risk that you think in this macro backdrop?
Well, it's great to be here in Houston, and certainly a pleasure to spend some time with this group. So we think the biggest risk is what we call an edgeless risk. When I say edgeless risk, meaning it's very difficult to forecast. We all have tools and resources we use to predict and obviously try to extrapolate what may happen. But I think the biggest edgeless risk out there is that the world becomes even more isolated more quickly, meaning the world is becoming really far adrift from the traditional trading blocks we've had for a long, long period of time. It's more transactional, more country by country, deal by deal, and that, let's call it repatriation of the world order, is a risk that I think is probably discussed, but the rate at which things happen is probably underappreciated. The last thing I'll say is this. It's a great quote in the book, The Sun Also Rises, which one character is asked, how did you become bankrupt? And he said, suddenly, but then all at once. I should say gradually, but then all at once. My English teacher's kicking me for missing that line. But the idea that this world order could actually kind of go drip by drip, but then change quite rapidly, that for us is probably the most underappreciated risk out there.
So are you thinking that we're entering in a world where growth and inflation both remain high for a while?
We do. I think that, we're approaching Thanksgiving. We think inflation is kind of like your in-laws that hang out the sort of Saturday, Sunday, maybe even the Monday after Thanksgiving, and it's like I still love them. I just maybe love them a little bit less. U.S. inflation projected at north of, let's call it 2.8, 2.9% through the middle part of next year. That's a very, very high rate relative to rest of world clocking in somewhere around 2. So we do think the glass is half full for growth. We actually think inflation, though, is probably hanging around a bit like the in-laws longer than we'd all like them to be.
I didn't say that. That was him. Gera, what's your read on the macro? And especially like from a portfolio construction lens, are you still defensive, or are you leaning a little bit more on the offense now?
Yeah, it's hard to believe, but we actually are pretty offensive right now. And if you think back to where we were earlier in this year, we talked about the first half of the year as being like the Rumpelstiltskin market, where if you'd gone to bed January 1st and then woken up in the middle of the year, you would have been like, I did pretty well. But of course, those of us who were awake for April knew how the depths of despair, right, from tariffs. But then even more remarkable, the second half of this year has really picked up steam. But we think it's not just running on vapors, right? When we look at corporate earnings power, it's really come back from those depths in the second quarter. We're in the middle of earnings season right now, and it could be shaping up to be the best earnings season in a couple of years. The Fed is much more accommodative. We also agree that inflation is going to remain sticky, but we think that the Fed's going to accept that and say 3% is okay. We've survived like this for long periods of time. And with that, they'll be able to continue to be somewhat more accommodative. So that becomes a really nice backdrop for risk assets. How we're putting on that risk is a little bit different today than where we were a year ago, but in general, we think it makes sense to lean into the market here.
Got it. So risk on for Gera. So David Solomon said yesterday that there's a tremendous backlog of large M&A going into 2026, 27. Stephen, is that true for the energy sector? And you speak with a lot of CEOs and CFOs. How are they positioning? Are they positioning for growth, or are they being a little more cautious right now?
I think you can bisect the sector a little bit. First of all, I wouldn't say there's a large backlog of M&A activity, because we have gone through a series of multiple years of pretty substantial backlog. 24 saw a lot of big transactions happen. 25, we're seeing a lot in terms of numbers of transactions, but they're smaller. So, the Conocos and the Oxys and the Exxons. Now Chevron got their deal done. The big cap companies in the energy sector have gotten deals done. Now we're seeing a lot of small consolidation. We saw a deal announced yesterday between Civitas and SM. So we're still seeing these deals. That doesn't spark another deal. The investor universe today wants to see fewer, larger, stronger companies with strong balance sheets. So that is going to force consolidation. When you ask about are these CEOs, CFOs poised for growth, I'd say the bifurcation, I would say, is on the oil side, much more cautious. We obviously have an administration right now that wants to see oil prices lower. I just came back from the Middle East, and I can tell you lower oil prices is not what they want. They are cutting back on some of their CapEx. I think they seem to be accommodative to our current administration for a period of time. I don't think that's going to be remain because they do have social costs, a break-even cost in the oil of somewhere between $80 and $85. I think they're very comfortable kind of in the $75 area. So I think while they're being accommodative today, I don't think that's going to remain. So oil, while being much more cautious today, and we see rigs coming off in the Permian Basin and the oily basins, the gas side is a whole different area. The gas side is poised for growth. We have three super trends going on in terms of natural gas. We have massive amount of LNG being built up in order to supply our allies around the world that need energy and need lower cost of energy. We see the AI data center. The power generation needed to drive that is going to be massive. And then thirdly, we got the onshoring of manufacturing that's going to require more energy and a lot of natural gas, a lot of power generation. So across those three super trends, I think everybody on the gas side can be very bullish and poised for growth. And that's, I think, where the companies are positioning themselves.
Got it. So, I mean, coming on the clean energy side of things, so what's the one macroeconomic or policy shift that could actually derail that, the clean energy capital cycle over the next 18 months, in your view?
Well, look, we had a derailing with the current administration, right? And candidly, I wouldn't call it necessarily a derailing. I think people still are focused on decarbonization, but in a smart way. And I think there's a debate in this administration, and maybe not so much a debate. Should it be done through capitalism or should it be done through incentives? And we can have that open debate. And there are still incentives out there. There's a massive amount of capital being spent now to meet some of these deadlines that have to be capital's got to be employed quickly in order to qualify for these tax credits. And there's other parts of the energy ecosystem that this administration wants to support, whether it be carbon capture or biofuels and some other things. So I think that the things that can derail it, we've talked about interest rates. High interest rates is not good for these big, large projects, right? So fortunately, this administration is accommodative in trying to push interest rates down, which will be very positive for some of these large projects that are being built. And Kevin earlier from P66 talked about the projects they're undergoing in some of the biofuels, and that'll be important. Tariff policy and the volatility around that is important because that's going to drive inflationary pressure. Inflationary pressures are not good for clean tech and for the projects that need to be developed. So I think there's and then thirdly, we need to figure out, candidly, where these tax incentives are, where domestic content's going to be, tax transferability, tax credit transferability, things like this need to be clarified. And depending upon how it's clarified, can either enhance clean tech projects or derail some clean tech projects.
Fair point. And I mean, being from the Bay Area, it is definitely fascinating for me how the stance on clean energy and policy changes when profits are being pursued in that sense, right? So, I mean, enough of the macro. Coming on to positioning in this uncertain environment from a portfolio perspective. Kara, let me start with you. Are we in a stock picker's market? And how are you positioning in this all this uncertainty and all these picks and pans?
So it's funny because I started my career as like a fundamental stock picker, and I think largely like those days are kind of over, right? The idea of coming up with your earnings model and trying to figure out who's going to beat. And if you look at the data, I mean, over the last 10, 15 years, it's been extraordinarily hard for a like true stock picker to be able to outperform the benchmark. Now, there are ways that I think you can solve for that by driving down costs, by actually taking alpha. But to the point of whether or not we're like shifting to an environment where we get back to a stock picker's market, I think it's potential. We've had an extraordinarily concentrated market over the last 3 years. So the bogey has been very, very high with the Mag 7 kind of dominating everything. And so as we think about putting portfolios together, it's yes, like are there ways that we can capture alpha through individual security selection? Are there other factors that we can identify where we think we get an edge? Moving down cap, moving into other types of factors or sectors. And we think that there are opportunities there. So it's sort of like using your full toolkit to be able to find sources of alpha and not necessarily just getting back to that, ooh, you know, this company's going to beat versus
Absolutely.
another one.
No, and I'm with you on that. So before we get in deeper into the positioning element of it, the one theme that we've seen come across the future investor panels across the year, be it SF, Atlanta, LA, was the US exceptionalism. And before we actually delve deeper into that, and I have some very interesting pre-conversations that I've had around that, again, guys, let's ask you all. Quick raise of hands if you think US markets will continue to outperform international markets in the next year, in 2026. Well, there we go. So if you had that view at the start of the year, you must have done well, and I'm your closest friend. But Eric, let's unpack. What is driving this exceptionalism, and what can get the US market to keep going, and what are the factors that you're considering around that?
The biggest drivers that we see behind American exceptionalism would be accounting standards, shareholder friendliness, rule of law, things that are maybe a bit more boring to talk about, but in fact are the hallmarks of I think the U.S. public equity market. Everyone on this stage has been in meetings. I remember sitting in Beijing in a room with a project that I thought had no chance of failing, and yet the rule of law concerns that we had suggested we should remain on the sidelines, and I'm glad that we did. So we can't dart past those underpinnings. I do think that the American exceptionalism, in terms of, and Kara nailed it earlier, that idea of a very narrow market, I think that AI has to go through a three-phase process in terms of our assessment as investors. Phase one we've already gone through, which is...
No, I'm not going to let you spit into AI just yet.
No. Well, but I think that the idea that, for U.S. companies to continue to do well, we have to remain in this phase, which is between, basically this notion that hyperscalers and the supply side of AI have basically a blank check to do what they want. And as long as that continues, then I think it's hard for the rest of the world to really materially outperform.
Absolutely.
But we do think we'll get to that other side, which I'm sure we'll touch on. So maybe some
I didn't mean to interrupt.
No, listen.
Every panel conversation just goes into AI really just right at the beginning, and we'll get there.
Yes.
But I completely agree, right? Like the whole innovation capital that the U.S. is building, there is a lot of tailwinds that provides to markets. And the big keep getting bigger in that sense. So 100% agree with you on that. Kara, you had your skepticism around this, right? What is worrying you? And how do you position if there are people who want to find alternatives? Like, if not the US, then where?
So I think it's very interesting, and it felt like 50-50. We're like thinking U.S. would outperform versus non-U.S. And my guess is that number is more balanced than what it would have been in the beginning of the year. And I say that just because I spend a lot of my day talking with individual investors, and many of whom were saying for many years, why do I own anything outside the U.S.? And there was really good reason, because for 15 years, the U.S. market, S&P 500 in particular, outperformed everything else. So it was really hard to kind of make that argument that you should own something outside. But then lo and behold, first half of this year, you have dollar down 10%. You have emerging markets that are up, 27, 28% so far this year. Most people have very small exposure to emerging markets. Meanwhile, it's the best performing asset class. So yes, the U.S. I think is still very much the center of innovation, all those reasons that you mentioned earlier. But all you need to have is sort of a narrowing of those expectations between the U.S. and the rest of the world in order to see the rest of the world outperform. And at some point, those valuation differentials reflect, the better position of U.S. markets.
So even a little delta
even
can
a
kind
little
of
bit.
move the flows a lot, right?
100%. And we have had long periods of time when U.S. dollar has underperformed and non-U.S. markets have outperformed. And it wasn't that long ago.
Absolutely. Eric, you also liked some global opportunities, right? What do you like between the EM-DM conversation or even within the EM space that we were talking about?
Yeah, we think it's probably an industry construct that should go away, the EM-DM distinction, just because let's call it the disparities across countries are so great. You think about China versus Brazil versus India versus Indonesia. These are entirely different entities. Yes, there's one commonality. They're not dollar denominated, but even in some of those cases, they're quasi-dollar pegged. So.
And the tariff conversations have completely changed the argument, right? Like,
I'd say that we were a bit underwhelmed coming out of the press briefing from Air Force One, not a political statement, but just like what was truly resolved from a tariff standpoint. Not really much. It was really more of a delay of what may come in future months or years. So, things that we like. So global infrastructure is a spot where we think that as this world becomes more challenged and as it becomes a bit more, let's call it territorial and less collaborative, getting content in hydrocarbons and petrochemicals from point A to point B is more difficult. And we like the idea of having some cash flow affixed to those assets, but also some embedded inflation hedges. Those are things that we like. We also think that healthcare, which has been a very underloved sector, is a spot that we think obviously has long-term tailwinds behind it. We're all getting older. We're all enjoying healthier, longer lives. That being said, that has to be funded in some way, shape, or form. So those are some areas that we think have some cross-border opportunities that are interesting.
Got it. And Stephen, how does energy transition kind of play in that space? How are investors positioning their portfolios around that mix?
Well, look, I think in today's world, we're still, I think 2024, we invest about $2 trillion in clean tech broadly. This year we'll probably be up about 10%, about $2.2 billion. So clean tech is still here, notwithstanding some of the pendulum shifts. But I think that money is shifting from a lot of new startups to more mature, larger scale, cash flowing businesses. So the larger renewables, more mature renewables, battery storage businesses that are capital intensive, infrastructure projects as we talked about. So I think instead of people throwing money at new science, there's been a lot of money lost actually by doing that. And so today I think people are focused on generating real returns in their clean tech investments, and those are pushing people to more mature businesses.
Absolutely. So again, let's take a pulse of the room. How many of you think that the next big unlock or delta will come from energy or industrials rather than tech? Raise of hands for energy and industrials. Oh, we have all tech supporters.
Not even you, huh?
I'm going to push as hard as I can. But
That's when rubber hits the road, guys. Okay, I think we have to get to your AI topic, Eric. I'm sorry. I think, yeah.
Let's do it. Let's do it.
Just one last portfolio part, and then we'll delve right away into that. So, Gera, fixed income is investable again. That's such an amazing,
it's not AI,
right?
but yeah.
I thought that, my children will be in a zone where we'll be constantly living in sub-zero or 0% interest rate environments. How are you thinking about credit and duration and spreads in this context?
So, as you suggested, the good news is that interest rates are much higher than they have been for a good portion of all of our careers. So there's actually some yield to be had. That said, when we look at some areas of the market, particularly high yield, we think that you don't necessarily need to go way out on the credit curve. Similarly, you don't need to go way out the duration curve in order to get that yield. Generally speaking, in other cycles, what we've seen is that as the Fed starts to cut rates, it's actually the belly of the curve that benefits the most. So that's where you can get some higher absolute yields. You benefit from somewhat lower rates in the middle part. And then particularly in things like corporate credit, where you are taking some credit risk, but we think it's very manageable. We think that's a pretty attractive place to be. And I don't know if you want to talk about private credit, but it's interesting because that you know, we've been cautious on high yield for a bit, but certainly more recently, a lot of the headlines about some oopsies, let's call them, in the private credit world have I think, pointed to some lazy underwriting. I don't think it's necessarily a sign of a great credit cycle coming, but I think what we have seen is that there's been some faster growth in certain areas of the market, and we're starting to see the strains from that.
Yeah, I think the moment credit kind of comes up on the radar, people react first and think later, right? So I completely agree with you on that. Yannick, I tried my best to put the AI discussion till the end, but I'm sorry, I have to, I can't help it. Guys, let's hear from you again. We can't talk about this without AI. So show of hands, how many of you, I think I know the answer. How many of you think we are in an AI bubble? Oh, we do have some people who believe that. That is amazing. Kara, I will let you address the elephant in the room. Are we in an AI bubble? And more importantly, what are the factors that you would consider to answer that question, right?
So I will preface this by saying I started my career in April of 2000, so almost to the day that the NASDAQ peaked. So my first couple of years on Wall Street were sort of learning the hard way the danger of a bubble, particularly a technology-related one. And so when we compare sort of like today's AI trend, let's call it, and compare it to the dot-com bubble, we see some like really significant differences that I think are very important. One is the earnings power and the free cash flow generation of these names. So, you know, the largest names in this space have gotten even larger, but they have done it by actually generating earnings. Now, what we've seen over the last couple of years is that valuations have increasingly diverged a bit from that earnings power, but that earnings has continued to increase. The other thing that I think is very important is that, you know, if you look at the 5 largest AI-related players who are spending CapEx right now, talking on the order of like $350 billion in CapEx by 5 companies alone, I mean, just extraordinary dollars. All that money is finding its way into the real economy. Now, I think it'll be a couple of years at least before we really start to see returns on these AI investments. But for now, all those dollars have to find a home. And by the way, 2026, I predict those numbers are going to be even higher. Yep. So right now, it's just money needing put to work in like real things, data centers, servers, power, and all of that has to find a home.
I guess the question or the challenge, or where my friends are worried about, is what if the market tomorrow starts questioning the ROI on those investments, right? Like how much patience will investors have? And as I said, like nowadays you've seen market response first, things later, right? And then the concept of this whole circular investing, and I'm sure everyone's kind of been following the headlines there. It just, I'm with you guys. It gave me a reminder of the whole GFC situation where all the interlinkages, we completely kind of missed that part of the risk equation, right?
But here's the problem. We've only got really one data center, one mega data center built. We're not even have these built yet.
Yeah.
We can't be in a bubble yet. We don't have the capital deployed.
Yeah.
We got billions and hundreds of billions of dollars that have yet to be deployed into the marketplace, utilizing all sorts of supply chains, all sorts of workforces. We haven't even started to spend that money yet. I mean, very infancy of that. Mm-hmm. We can't be in a bubble yet. We're years away from being in a bubble.
I like that conviction. Eric, are investors really underestimating the productivity impact of AI? How are you kind of thinking about that?
We think there's over-extrapolation. I mean, I'll give a couple of examples. One is that this is not a very well-diffused technology yet. I mean, there is a significant supply constraint that exists. Think about, like, just go through NVIDIA's last quarter. Think about the major supplier, the glut of obviously, I should say, the hope of more chips arriving. this just hasn't been, there's been so much focus on the supply side. The demand side is when we'll know if we're in a bubble. If every company that comes out with a somewhat credible AI plan from a use case standpoint and talks about sustainable returns, and if that premium valuation is just over premium, that's something that says to us we've gone too far. We're not there yet. And so I think that, I'll give you an example. There are some applications, like I was in Ohio 2 weeks ago. We're a large user of AI at US Bank. Built a presentation, a deck using AI, spelled the word Ohio, and said, hey, can you design a slide with these inputs? And we have a very souped version of AI. It spat out the wrong spelling of Ohio 7 straight times. Now, that's a very low-risk output, right? I could have swapped to PowerPoint if I so chose. Not the end of the world. There are other transactions, like financial transactions or medical applications, where there is zero room for error. Money is lost permanently, someone dies. Those are applications that have not yet been fully filtered in. So I do think, if we kind of harken back to things like 3D printing, everyone in this room is supposed to have a 3D printer at their house. How many people in this room have a 3D printer at your house? Raise your hand, please. 2, I believe maybe 1 or 2. And so, look, we're all using it. It's all being used on us, but the applications have not fully diffused yet. That return on invested capital, return on capital employed argument, I think probably happens quicker than late 26. I think there are going to be some companies that are held feet to the fire more quickly than that. That's when we'll know if we're in a bubble. We're not there quite yet, but the test will come. The test never came. I started a year and a half earlier than my colleague to the right. San Francisco, Goldman Sachs printing 3 deals a day. This is very different than where we were at that juncture. So I think that there's still time to tell, but that diffusion is something that is certainly important for us to all assess.
Well, we can do another assessment right in this room. How many of you actually use AI for your day-to-day workflows, for work? So we do have demand. And how about personal stuff? Oh, yeah, for sure. My 12-year-old is writing code in AI, with AI, so I completely buy into that as well. Stephen, you've been watching the deal flow. Where is the one area where capital is flowing quietly and people have not paid attention?
Look, I think we talked about the data center, so let me start it by tying into the data center. We have a huge amount of power generation that needs to be distributed to data centers all across the country, Canada, all across the world, but let's talk our country, all across the country. Our grid has not been upgraded in 30 years, right? So we need substantial amount of capital deployed to the grid. And what I think we're going to see that is in smart grids. We need to be able to really deploy the capital into making our grid smarter, much more efficient, much more resilient, and much more dynamic. And so things, sensors, AI, sensors, meters, I think these are all areas, anything to do with the grid on grid efficiency, utility services is going to be another big area. You see that going on now. Anybody who touches utility services, whether it be in the clean tech area or even in the much more developed areas, are growing at rapid paces. Their share prices, if they're public, are exploding. So these are areas that are clearly going to happen. I think the other thing we need to do is, while we need a lot more energy from all sources, hydrocarbon and renewables, et cetera, we also need to be able to use our energy much more efficiently. So anything in the energy efficiency area, I think, is starting to really catch on. People are developing new technologies in a way to make energy more efficient and be able to conserve more of what we have rather than use it in less efficient ways. So I think those are 2 key areas that I think people are really starting to identify investment opportunities and starting to put a lot of money toward.
That all makes so much sense. So, and what is interesting is when you see correlations between energy, industrials, and tech, that kind of tells you another story, right? Interestingly, we're at time. Ladies and gentlemen, thank you. So the one thing that I would love for you to take away from this panel is the next cycle of returns is not going to come from doing more of the same thing. And that's the one takeaway that at least I had from our conversations. So we need investors need to be more curious, flexible, and forward-looking. And the US exceptionalism play, we cannot take it for granted. So let's keep our eyes and ears open and charge along. Thank you so much. You've been a lovely audience. Thanks a lot for spending your evening with us.
Yeah.
Thank you.